American debt has just crossed a number so large it barely sounds real anymore, $1,250 billion sitting on credit cards alone, in the pockets and wallets of ordinary people. But the number itself isn't the story is what's hiding behind it. Because somewhere tonight, a family is sitting at a kitchen table doing math that doesn't add up. The paycheck came in, the bills are laid out, and no matter how many times the numbers are rearranged, there's a gap, a small one, maybe just a few $100s, that has to be filled somehow. So a card gets swiped, a balance gets carried, a payment gets pushed to next month. It feels like a private moment, a small, forgettable decision. But multiply that moment by tens of millions of households, repeat it month after month, and that trillion-dollar figure stops being abstract. It becomes the outline of an economy that is quietly being held up by borrowed time. On paper, the United States looks like it's doing fine. Stock indexes climb. Unemployment numbers stay low. The language coming from official channels is steady, confident, even upbeat. But step away from the headlines and look at a different kind of data, the kind that doesn't usually make the front page. Total credit card balances in the U.S. $1,250 billion. And tucked inside that figure is something more troubling. The share of accounts that are seriously delinquent, more than 90 days past due, has risen to levels not seen since the aftermath of the 2008 financial crisis. Two very different stories are being told about the same country at the same time. One is about strength, the other is about strain, and the gap between them is where this story lives. Debt rarely arrives as a single decision. It builds in layers, almost too small to notice. Picture a household a few years ago, stable, manageable, nothing alarming. Then the renewal notice for car insurance comes in higher than last year. Then the rent goes up. Then a grocery run that used to cost one amount now costs noticeably more. Then the water heater breaks. None of these on their own would sink a budget, but they don't arrive on their own. They arrive in a slow accumulation, stacking on top of each other until the space between income and expenses, the breathing room every household needs, simply isn't there anymore. The first response is almost always the same: cut back, the vacation gets canceled, dinners out become rare, streaming subscriptions get trimmed. For a while this works, belts tighten, and the budget holds. But there's a limit to how much tightening a budget can absorb. Eventually the easy cuts run out, and the expenses keep climbing anyway. That's the moment when credit stops being a convenience and starts becoming something else entirely: a bridge. A bridge implies two solid sides, a temporary gap with stable ground on either end. For a long time, that's exactly what credit was for most families, a short-term tool to get from one paycheck to the next, or to cover something unexpected until things normalized. The trouble starts when the other side of the bridge never arrives. When the gap between income and cost doesn't close, it just gets walked across again and again until what was meant to be temporary becomes permanent. And permanence changes everything, especially once interest enters the equation. With many credit card rates sitting above 20%, every payment a household makes is essentially fighting on two fronts at once, chipping away at the original balance while simultaneously feeding the interest that keeps growing in the background. Progress slows, the balance becomes sticky. What looked like a short-term fix starts to resemble a long-term sentence. This is where individual stories start to matter at a national scale. Because this isn't happening to one family, it's happening to millions in parallel, at the same time, across different incomes, different professions, different zip codes. What used to be framed as a problem isolated to lower-income households has been creeping steadily into the middle class. The pressure looks different depending on where you sit, but the direction is strikingly consistent. To understand why this matters for the economy as a whole, it helps to remember one basic fact. Consumer spending is the single largest driver of U.S. economic activity. When people buy things, businesses hire. When businesses hire, more people have income to spend. The entire engine depends on consumers continuing to participate. But there's a critical difference hiding inside that simple idea, a difference between spending that comes from income and spending that comes from borrowing. From the outside, a transaction looks identical either way. The cash register doesn't know the difference. The GDP report doesn't know the difference. A sale is a sale. But underneath, the foundations are completely different. Income-funded spending is self-sustaining, it can repeat indefinitely. Debt-funded spending borrows from the future to pay for the present, and at some point, that future bill comes due. So when economic activity looks healthy, a harder question is worth asking: how much of that activity reflects people doing well, and how much reflects people running out of other options? That question becomes sharper when you look at one of the fastest growing corners of consumer finance: buy now, pay later services. These products were originally pitched as a way to split big ticket purchases, electronics, furniture, trips, into smaller, more manageable chunks. A flexible alternative to a single large payment, but the way people are actually using these services has been shifting. Increasingly, surveys show these installment plans being used not for discretionary purchases, but for groceries, medical bills, and everyday essentials. And that shift says something important. Financing a television reflects a preference about how to pay for something you wanted anyway. Financing your groceries reflects something closer to necessity. One is a choice. The other is a signal. It's tempting to frame all of this as a story about personal responsibility, about people spending beyond their means, failing to budget, making poor choices. And sometimes, that's part of the picture. But it's an incomplete picture because it leaves out everything households don't control. No family sets the price of housing in their region. No individual negotiates the cost structure of the healthcare system. No consumer votes on interest rate policy. Insurance pricing, energy costs, the broader cost of living. These are forces that act on households from the outside, regardless of how carefully anyone budgets. This is why the disconnect between the economy is strong and my life feels harder isn't necessarily a contradiction, it's a reflection of how aggregated statistics work. National averages can rise even while a meaningful share of the population falls behind. A booming stock market doesn't pay anyone's electric bill. Strong corporate earnings don't automatically translate into cheaper groceries. GDP growth doesn't guarantee that an individual's paycheck stretches further than it did last year. And when that gap between the official story and lived experience grows wide enough for long enough, something more fundamental starts to erode: confidence. Not confidence in the stock market, but a quieter, more personal kind. Confidence that effort leads somewhere, that planning for the future is worth doing, that next year will be more stable than this one. Debt accelerates that erosion. A household carrying heavy monthly payments doesn't just have less money, it starts making different decisions. Big purchases get delayed, plans to start a business get shelved. Risk-taking, the kind that drives long-term growth, gets replaced by a kind of permanent defensiveness. Spending that might have happened in the future gets pulled into the present to cover today's gaps, while the flexibility to handle tomorrow's surprises quietly disappears. History offers a familiar pattern here. Debt tends to expand quietly during periods of economic pressure, and for a while it works. It masks the underlying strain. Spending continues. Activity looks steady. The system seems to be holding, but debt is not a substitute for income, it's a loan against it. And loans get called in, one way or another, through credit limits being reached, through cash flow simply running dry, or through people deciding they can't carry any more. When that threshold arrives, the unwinding tends to happen far faster than the years-long buildup that preceded it. None of this guarantees a crisis is coming. Economies are resilient in ways that are hard to predict. Households adjust, businesses adapt, policy responds. The future isn't written yet. But the $1,250 billion sitting on America's credit card statements isn't just a number. It's a record, a quiet, distributed record of millions of households making the same kinds of decisions, for many of the same reasons, at roughly the same time. Whether that record reflects irresponsibility or strain probably depends on who you ask. But underneath both interpretations is the same unresolved question, sitting at the center of the modern American economy. For years, consumer spending has been one of the things holding the whole system together. So what happens if the consumers start running out of room?